Hello, everyone, and welcome to today's major markets update for Monday, March 14, 2022. Corrections are always complex. They are the most difficult price structure to track, let alone trade and forecast. Why? Because they're overlapping and can morph into many different types of patterns. In my cryptocurrency update, I went over corrective patterns as well because they are correcting, most of the cryptocurrencies are. And with Bitcoin going sideways, it is then always a good time to review the possibilities as things go sideways. Elliott wave kind of falls apart in its certainty, but once things are trending, it gets much easier. But bottom line is, after 5 waves up, you expect 3 waves lower. How those 3 waves exactly are going to fill itself in is unknown. We can have a zigzag, we can have a flat, we can have a triangle. Please go on my website, click on education on the menu, education, Elliott wave, and look at the different types of corrections we can have. All right, a zigzag can be single, double, or even triple. There's 3 types. Triangles can be ABC, ABCDE, can be ascending, descending, and symmetrical. So that's 10 different corrections. Flats can be regular, irregular, expanded, or running. That's 7 different flats, I believe. So there you have almost 20 different types of corrections, a plethora of corrections. So when it starts, please excuse me if I don't know which correction is going to be. Then we can look at wave 2. If wave 2 is, say, a zigzag, wave 4, based on the rule of alternation, is most likely going to be a flat or a triangle. All right, we narrowed it down. No more zigzag. Still a plethora of different types of corrections left. Still don't know which one the market is going to take. All righty, we're seeing 3 waves down. Okay, that could be the start of a triangle because triangles are all threes. 3 down, 3 up, 3 down, 3 up, 3 down, 3 up. Can go on for quite a while. Flats are 3 down, 3 up, 5 down. But with 3 down, we don't still know yet. Then we get 3 waves back up. If we're going to make higher highs, retrace more than a certain percentage, then we start to eliminate a triangle versus a flat. So there you see how far along price has to go before you can actually get a good notion on what it's ultimately going to be. So how on earth people think you have to know exactly when the correction starts, how it's going to unfold is beyond me. But LMCP of that one is limited mental capacity, right? You got to be able to anticipate, to monitor, and adjust. All right, we anticipate 3 waves down. How those 3 waves exactly are going to fill themselves in, unknown, impossible to know, but we know it's going to happen. 3 waves at the minimum. It can then turn into 3, 3, 3s. That can continue. So with that, I always then monitor how are these 3 waves going to unfold, and we anticipate, especially during corrections, because they are so inherently variable, where we can have so much overlap, right? In impulses, you technically can't have overlap. 1, 2, 3, 4, and 5. None of it overlaps. Most of the time, hit standard Fibonacci extensions. I'll show you that in a minute for the Nasdaq. It's relatively easy, because the markets are never easy. So when I posted this chart and I showed you this on Friday, it shows that we are in a diagonal type of pattern. It's still in a diagonal type of pattern. This is what I call a bullish wedge and nothing out of the ordinary. We still have only done a 13% decline on a closing basis. So everybody's running chicken littles, but remember, when everybody thinks the market will go down, it will go back up because everybody has sold and only buying is left. And this market is trying at its very, very hardest to make everybody believe it's better to shoot yourself, hang yourself, kill yourself, do whatever, because it's the end of the world. Honestly, that's all I get to hear on my Twitter feed from other people. It's dire straits out there, right? If that's the case, then we should just close the doors, lights out, but it's not. It's really not, because the markets are telling us a different story. I prefer to listen to price. All right, you can say, well, babble all you want, we're crashing. No, we're not. This is still a valid diagonal pattern. I know the price levels that tell me where I'm wrong. It would be around S&P 500, 3,600. Okay, that's where I go. Okay, my assessment is wrong. And I know I'm wrong to prove I'm right. But so far, this is the pattern that we see. This is the pattern that we have to deal with, so it's valid. With this pattern, knowing that this really looks like a diagonal, I have to wonder if the wave count I had originally was correct. Okay, we anticipate, we monitor, we adjust. We had our all-time high here in January 2020, which arguably was a irregular flat with a B wave high making all-time highs, A, B, C. Counts best as a B wave. Can make it 5, it's a little ugly, it's fine. What we then got is 3 waves lower into January, not 5. This is 3. Whatever way I try to count this, wherever I look, I can go to 1 million gazillion. This is 3 waves. Look at the closing prices. This is 1, 2, 3 waves, with 5 waves lower for the C wave. 1, 2, 3, 4, 5. Picture perfect. So this is 3 waves. Then we got the bounce into early February, and we overlapped with the wave 1. Except, I believe, for the NASDAQ100, everything overlapped. Yeah, well, only in diagonals can wave 1 and 4 overlap. Okay, so this is then suggestive of a diagonal. Diagonals are either C waves or first waves. A waves can also be diagonals, but most of the time it's first and. Okay, we already have had the A wave, so this can't be a wave. Simple. So this is a diagonal type of pattern. It can't be a standard impulse. I'll show you the Nasdaq on how well the Nasdaq tried to mask itself as a standard impulse till it kind of fell apart. So we have this overlap. All right, we'll let it happen as it is, or stay as it is, and then we got the next decline. This next decline here, going into the February 24 low, is similar to what we had in January. Also 3 waves. Again, 3 waves. 3 waves are part of a corrective pattern. Impulses consist of 5 waves. Look here, 1, 2, 3, 4, 5. Loud and clear, cannot argue with it at all. This is arguably 5 waves, but most likely 3 waves. Everywhere you look, it's 5 waves higher, and then we get the overlap to the downside. So then the question mark is, did we bottom at the invasion low, right? This is February 24th, when unfortunately Russia decided to invade Ukraine. Well, they decided that probably a decade ago, but that's something else. More about that in a minute. So I wondered if this is the start of a new impulse or a wave 4 that has remained on the charts all the time. So people tell me that I don't know what I'm talking about. Do not listen, do not read the charts. That's on you. I cannot be more clear than that. Please see the charts. So question then is 4. Again, overlap with 1. Yuck. Corrective. Again, suggestive of a diagonal pattern. Okay, we must recognize that. Alrighty, then you go, is this then really 1, 2, 3, 4, 5 here, or is this something else? Well, we now know the NASDAQ100 and the NASDAQ went slightly below the February 24th lows. I always said those need to hold. If they don't, we're going to go lower. Well, they didn't hold for that index. They already failed to hold for the semiconductors last week, but the semiconductors are still tracking along as I anticipated. So no mistake there yet. Not that this is a mistake either. It's simply where we anticipate, we monitor, adjust. How 5 waves lower are going to fill themselves in is unknown. We start off with a standard impulse, which eventually can morph into a diagonal. Indeed. So here we have 3 waves lower. Again, I said this is all overlapping. It doesn't really look good as but I would say 5 non-overlapping waves lower. So 1, 2, 3, 4, and now in wave 5 of C of 5 of 4. It counts much better as ABCs. Everything counts better as ABCs. A, B, C, A, B, C, A, B, C, and the C wave again, A, B, C. Looks good, A, B, C up. Then the A wave really looked like 5 waves. That's why I said last week on Monday, I spy with my little eye 5 waves higher, with, of course, the caveat that 5 waves can be an A wave and that I had the green 4 as the alternative count. Well, that seems to be now the preferred count, and we can still target to as low as these levels. Nothing out of the ordinary. We need to drop here below, as I even a little bit south of 3600 before this all falls apart, and we're in super cycle 4. Okay, super cycle 4, as I showed you, will bring price down to 2000, even lower, whatever it is, it's fine. We're miles away from it. So don't have to worry about it yet. Now, ending diagonals are ABC patterns. Most of the time, threes, it's all threes, because their ending is confusing. So this looks way better as a ending diagonal. It fits this one as well. Now, this could be A and B, and this is an ending diagonal C wave, fine with me. All right, so A, B, and now we're in this ending diagonal. Potato, potato, it gets us to the same lows. So here is then the Nasdaq 100. Okay, the Nasdaq 100, lo and behold, finally went below the February 24th low. All right, I told you it was possible. It wasn't my preferred view, but it seems like every time I prefer something market to something else. Why? Because of this bleep overlap. Let's put it like that. So here we have 5 waves lower, 3 waves up, and then we have, it counts best actually as 3 waves lower once again. Right? On a closing basis, 3 waves lower. Look how we nailed to 161.8% extension to the T almost, and that's typical for a third wave. So then we go, okay, internal waves be damned, good enough. Then the fourth wave, as you remember, should have topped somewhere here. It didn't, it topped here, and we got overlap with the one and the one low here. So I can arguably say maybe the fourth wave was here. So I switched it. We had a failed C wave. Okay, it's exotic, don't like it. And then I was tracking the drop, and again we bottomed right at the 200% extension. That is reserved for the fifth wave. All right, that is the standard impulse pattern that we are always tracking. That is the standard impulse pattern. Just convert this one or inverse this one to the downside and you'll get the same. So that also argued for, okay, we have a completion of wave 5. The internal price structure looks a little weird, maybe 1, 2, 1, 2, something like that, but we got there, okay? And then we started to rally, which again looked like 5 waves, but it's not because we went below it. So how can we then resolve this issue? This issue is better resolved with a 1, a 2, a 3, a 4, and now in this wave 5. Because of all the overlap. Okay, so shorter term, been working diligently on this all day. Let's have a look. So we have our B wave bounce here in December, A, B, C. Again, it looks much better on the hourly time frame as 3 waves lower. This is not 5. Look, this low here is 161.8 times the length of wave A. Okay, A, B, C. If you were doing the Fibonacci extensions, perfect. Okay, then we get 3 waves up, wave 2, A, B, C. Once again, 3 waves lower. It's all threes. A, B, C, A, B, C, A, B, C. 3, 3, 3, 3, 3. Sounds like a ending diagonal. The internals are 5s. That's fine. We have the internal A wave here, B, and then this C of C. Again, I can do the Fibonacci extensions there as well for the internals of C, because this decline here, I cannot really make it into 5 waves lower unless I get kind of exotic. Okay, if I get kind of exotic, it's okay. So there we go. And what do we get? Almost exactly 161.8. Again, that is reserved for third or C waves. 9 out of 10 times, that's what we get. You can get the extension as we got, but it had to overlap because now we have the wave C of C right where it had to allow for this. Okay, so that is nice. We have picture perfect overlap. C is 1.618 times A. Okay, for the Nasdaq. Looks good. Nothing to argue against about. 3 waves. And then we had 5 waves higher. Remember, I spy with my little eye. 1, 2, 3, 4, 5. And then a failed, I would say, C wave, because wave C of wave 4 was very little, but it is a C wave. It was 5 waves higher. Then we got an impulse lower, which I originally labeled as the possible A, B, right? We had this as wave A then, so we had the possible that was wave 1, wave A, wave B, and wave C, okay? Well, that didn't happen. It was not a expanded flat because we were, of course, now below the lows. We anticipate, we monitor, we adjust. So now we have another impulse lower. Looks good. And how low can this impulse go? Let's have a look here. We can go to about the 12,000s, okay? Not out of the ordinary. We should set ourselves up for a nice completion of this diagonal. This is still a very nice diagonal pattern. What happens when a diagonal completes? We get blast off to its origin, which is at around 15,000, arguably about 16,500. I'll tell you in a minute a little bit more on why we might actually see new all-time highs based on other indicators. Okay, but so far so good. I think this newly adapted wave count looks good. I like it better. This is where we anticipate, we monitor, and we adjust. We had reached these typical Fibonacci extensions that are classic for 3, 4, and 5, except for the wave 4. It wasn't really playing balls. Okay, again, that's where you say we get 2 out of 3 correct. That's where you get 70% of your reliability. Same here then for the Nasdaq 100. Also this one, if we would do the Fibonacci extensions, has a nice Fib action or extension, not action, extension of about 161.8. Okay, so this is the one, the initiation wave 2. Look at that, picture perfect, right? And then of course we got the wave, original wave 5. Look at that, picture perfect. It doesn't get more accurate. Look at that, unbelievable. So it is logical then to assume that this wave 5 could have been completed. But we knew we were dealing with a potential ending diagonal pattern. This targets about 12,132-ish, ideally, okay? Doesn't have to get there. It doesn't have to. Again, it's all ABCs. It looks all better as ABCs. It's all ABCs. I like it much better. Here as well, this is then 1, 2, 3, 4. It's fine to count it this way. It's okay. Looks reasonably correct. We can also change it this way. Again, 161.8, A, B, C. Then we have 2, A, B, C. This is 3 with 5 waves lower, A, B, C. And now again, A, B, C. And you can see the downside targets. So far, so good. So this starts to fit better with a ending diagonal C wave, which is not uncommon. Here we have the semiconductors. The semiconductors still following along this 1, 2, 3, 4, 5. I would have liked to see wave 3 bottom at around 31, 32. Well, it fell a little bit lower at around 30, 60. It rallied a little bit higher. Again, lots of overlap. It's all overlapping. Overlap, overlap, overlap. So again, this looks also better as a ending diagonal. This one is so far not doing anything other than not exactly adhering to the Fibonacci's. But that's okay. That is part of ending diagonals. They are more overlapping. Okay, and we get something like this. We might actually have to start doing it like this. It's all overlapping and it still looks like a ending diagonal with here the downside targets. I have had those here for a while. We failed here on the 3. The 4 did something weird, so we might still get down here and retrace the entire rally since May last year. Nothing out of the ordinary, okay? That is at around 29.50, 28.50. This has been on the map all the time, no surprises, okay? Nothing that is where you can say, oh, you didn't say it. It's been on the charts, and if you don't read the charts, then I can't help you. That's just the way it is. That's why they're there. That's why I sent them out. Please do so. So semiconductors still on track for this wave 5 of 5 of C. Okay, nothing out of the ordinary just yet. Dow Jones, last but not least, again, it bottomed here for this wave 5, right in the ideal target zone, okay? It does not always have to adhere to it. So is this wave 3, this is 4? It's possible. Considering the Dow Jones's ugly price action over the last few days, I'll just leave this one for now. It still looks also better as all ABCs, okay? Ideally, I would have seen it, like to see it bottom here, top here, and then drop, according to these blue arrows. But the market reserves the right to do something else. It doesn't owe us anything. I keep saying it, and it shows you how complex and complicated corrections can be. Just like we had here, this expanding ending diagonal. Can do it always. Always be prepared for the unexpected, especially during corrections. Again, the B wave looked really like 5 waves higher. 1, 2, 3, 4, 5. That's why in January, February, I was starting to get bullish because this looked like a leading diagonal. And we knew if we would drop below the January lows, it's not a leading diagonal. And we had certain warnings. We should not have dropped below 34,150, somewhere around there. And we did. So those were all the warning levels to look at, right? I always tell you what the warning levels are for breakouts and breakdowns. So the Dow Jones is still a bit more muddled, shorter term. It can have completed its correction already. I prefer also for it to make a lower low, so it all looks like a nasty overlapping correction, so to say, with this A, the B, and the C, and then we'll simply move this one here. Again, we bottomed here, which is typical for a fifth wave, but then it was a third wave. Then we had this one here, and this is, of course, the other way around there. 1, 2. No overlap for 4, and then maybe in wave 5 of C of 4. Okay, nothing out of the ordinary here either. Okay. So covered our bases, we anticipated, we monitor, we adjust. 2 weeks ago, I got all the turns correctly on the shorter term. Last week was a mess. I didn't get that correct. Excuse me, pardon my French. I can't get it always right. More about that in a minute. The devastation is of trying to find somebody who's always right. So here we're then going to analyze what other people are looking for. Here is the person who introduced me to Elliott Wave many, many years ago. He's still at it. I love it. He's a perma bear. His name is Pretzel. Well, it's not his real name. It's fine. But he's either looking, if we look at it, he's good at the potential wave 5 lower. Okay. Okay. Fits what we're potentially looking for as well. Okay. We can live with that, right? And he even had the option, of course, for moving higher. We knew it. We had to break above the early March highs or late February highs to move higher. Now he's a perma bear, and he even now starts to warn that we might only have a wave 4 and then a wave 5. I've shown you the NYSA chart. This is the NYSA or NYA. That this is option. If the perma bear starts to wonder, we might actually get a extended wave 5. That's what he's warning. If you read this text, I would say pay attention. I don't agree with his wave count here because this 3-4 should be 3-4, and then 3-4 everything shifts forward a bit. I don't understand why he labeled this as 3-4. It's fine. I'm not here to piss on his territory. What I mean is that somebody who's always very bearish about the markets might think there is actually another wave to go. Okay, excellent. Fine with me, just to make sure that we are covering our bases. And here we have our dear friends at wavetrader.net also looking for a potential lower low in the 4,000 level. Nothing out of the ordinary. I've said it many times. Then the wave count they have needs to be adjusted. But as you can see here, it's all overlapping. Overlap, 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 overlap. This is part of a correction. Even if this is the A wave of a very large bear market, there's going to be a B wave. We haven't even seen the B wave yet. All right, it's coming. Anyway, so now we have 2 out of 3, 3 out of 3 that are still pointing towards a possible wave 4 low. Okay, so I wanted to point that out. Lastly, this is an interesting article by Tom McClellan on the corporate high yield AD line. It's declining. It's not good for stocks because high yield is really the father of the stock market, super high risk, and people are not taking any high risk. In this article, he presents what he then calls is the corporate high yield bonds ratio adjusted McClellan AD summation index. It's for free. You can go on his website. Data is only available since 2005. Okay, so it's very, very limited. We have a partial bull, one bear, and another bull. So it's very limited. But what he sees here is that when the AD line drops from a certain level, high, to below minus 500, pretty much falls out of bed, then rallies again, that's the first sign of trouble. It happened here in 2007. It happened here in 2014-ish. It happened here in 2016. And again, look how oversold the current market is, more so than 2020, almost close to 2009. Okay, so if we use the analogy of a beach ball being held underwater, eventually that beach ball will breach. So then I looked at what does the market do after the sign of trouble? It made a new all-time high. It made a new all-time high. It made a new all-time high. Tom McClellan concluded that there are signs of trouble brewing. We should see a big bounce soon. but honestly, it is 3 out of 3 a new rally to new all-time highs. Fits with my fifth wave scenario, fits with Pretzel, fits with Harvey Gilbert. So again, this is totally not Elliott wave. This is a objective analysis of a D-line summation index behavior and how the market, 3 out of 3. I know it's limited data. We're only going back to 2005, but 3 out of 3. Okay, this is statistically significant, bringing science to the markets. New all-time high first before we see the exhaustion event. We'll deal with that one later. But for now, look how extremely oversold this indicator is. And Tom says as well, it looks like we're getting much closer to a bottom than to a top. All righty, so that's that. Nothing there. Then the last part I wanted to cover is fear and greed. This is not about bearishness and sentiment and that type of stuff between investors and money managers and all these things. But this is, and I'm going to share it with you, about fear and greed within yourself, style drift. Here we have the grass is greener on the other side, the greed. All right. An example is this investor held on to his investments and is up 50%. Now that sounds like, man, I got to do what this guy does. But then you read further in the article, as the author states, Greg Morris on stockcharts.com, that this person has done a lot of readjusting. He didn't panic, but he had to do a lot of work, 20 to 30 hours per week to get that performance. All right, it's just not sitting on his hands. So is there then a perfect investment strategy? No, there's not. There is no perfect investment strategy. If there's not, then the next question is, then why do you keep changing your investment strategies? I literally been told that somebody says, I'm going to change my investment strategy, but there is no perfect one. So why then change it? Okay. There is no safe strategy. Okay. And what it is the people are starting to look for a safe strategy. But looking for a safe strategy is the worst choice because you try to avoid risk. But there is no risk market. Okay. And the greatest risk of all is to fall prey to this safe strategy, the strategy that you never lose money. Okay, but if you do this, you're actually inflating yourself, according to the author, that your purchasing power will erode over time because you keep running from market guru to market guru. You keep running to safe strategy to, it doesn't work, doesn't work, doesn't work. And you keep eroding your strategy. It's the same with the Elliott wave, right? If I go here to the Elliott wave, it worked here perfectly. 1, 2, 3, all the target zones reached. Boom, boom, boom. So why doesn't it work all of a sudden here anymore? Has the market all of a sudden just abandoned Elliott wave? It worked here, 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 nailed it every single time. So we simply have to adjust and monitor it, but it will work. It will adhere to these Fibonacci levels. It will adhere to these waves. The market just doesn't abandon all of a sudden this type of mathematical precision. It's simply a matter of, have I correctly anticipated these lows and highs? So there is no safe strategy. There is no perfect investment strategy. Okay. But one thing is clear, is that what happens is people abandon ship during difficult times. I see it loud and clear, but they abandon ship when the storm is essentially over. All right. And that's when you suffer through the worst phase of your investment strategy, because you just don't hang around long enough to enjoy the good times. So really, if you're having problems with your investment strategy, contact me and we can work on things, okay? Don't make long-term decisions based on short-term results. As I always say, people cannot see the forest through the trees. You got to have discipline and stick with it, all right? Stick with it. The market keeps adhering to these Fibonacci levels. It's simply a matter of how it's filling in these A, B, and C waves in its overlapping fashion. It's impossible to know beforehand, but I'm going to stick with this methodology because I know it works. It just worked in the fall and summer of last year, so why shouldn't it work now? If anything, it was my initial interpretation of the price action that's wrong, but I keep adjusting. It was right, wave 3, wave 4, wave 5, and then the market did something else. That is okay. Nobody has all the answers all the time. But I wanted to share you this one with the fear and of missing out and the greed of, oh, look at what the other person is doing. I'll keep changing and do what this person does. You might take a few bits away with it, but please remember, it takes a lot of work and effort to get a good return out of the markets. Nobody said it was easy. you look at the Wall Street firms, they hire thousands of people. I know there's surely a lot of red tape, a lot of bureaucracy going on, but they don't perform well just because they have a few people sitting on a lounge chair trying to trade from their cell phone. That's not how you get excellent performance. Or I'll get back to this later. I'll get back to when the market is up. It just doesn't work this way. It's hard work. It's really hard work. It's diligence and it's blood, sweat, and tears. And I'll try to make it as easy as possible for you. But I really want to point this out because I think this is a fantastic article that is as timely as it ever can be, considering where the markets are and where sentiment is. Okay, so I hope you're going to enjoy that little extra bit of information. That said, on Friday, the short-term, I said the short-term price action was clear 2 weeks ago, less clear last week. So it operates the markets from clear to ambiguous to clear, etc. So I had the wave 1, 2 set up or the end on diagonal C wave not yet complete. Well, the Nasdaq and NASDA100 have showed the diagonal C wave is not complete, but again, both options will ultimately resolve higher. Still looks like the diagonal pattern is in play. So today I assessed all the charts to make them clearer from an Elliott wave perspective. Remember, corrections always comprise of overlap. Lots of it. The current price action, as I showed, is no different, and that's why it's so difficult to nail it down exactly. But it supports the notion this is a correction and not the start of a massive bear market. We haven't invalidated any downside levels yet. We know them from the previous webcast I did, so we're not there yet. And remember, even the perma bear, and that's nothing wrong with it. We are what we are. This is what makes the market. Somebody are perma bulls, perma bears, neutral. It's all good, but is now changing to the option that we are only in a wave 4. Excellent. Again, we anticipate, we monitor and adjust, especially during corrections that will happen all the time. Remember, the NASDAQ100 nailed to 161.8, looks good for a third wave. Internals were a little weak for that third wave, good enough. Then we got the February 24th wave, fourth low at the 2% extension, typical for a wave 5. Then it's logical to assume that the wave to the downside has completed. But we didn't get a good Fibonacci retrace for the wave 4, overlap with wave 1, so there were still some caveats. Well, there we have it. The caveat was the ending diagonal C wave. Again, the price action remains overlapping, counts all better as ABCs, which is part of a diagonal. Looks like we're getting close to completion. Look for the downside targets on the charts. Remember, in my humble opinion, nobody's allowed to believe in an extra rally. Absolutely nobody. Everybody has to believe the end of the world is here. And with that, I want to leave you with a kind of, I hope it's fun, fact, where I can spot a 30-year generational cycle. This is about communism and Russia. As of course, that's of course the headline news. The Russian Revolution started in 1917, which is when truly communism starts, unfortunately. 1947 is when the Cold War officially started. All right, that's 30 years. The Cuban Missile Crisis is considered the height of the Cold War. That's 25 years later. 1991, the Berlin Wall fell, and it was the dissolution of the USSR, but not of communism. All right, actual USSR was dissolved. That's 29 years later, from 1962. But then in 2022, Russia unfortunately invaded Ukraine. Is this the end of communism? Is this the unraveling? That's another 30 years. According to The Fourth Turning, it's a fantastic book. There are 4 generational cycles. The last one is the unraveling, and we might just have seen the unraveling of communism. And from my humble opinion, I really hope so, but I don't want to see it, of course, end in bloodshed. It's probably better if we can unravel it peacefully. And I hope we are able to do that pretty soon. It wouldn't surprise me. I thought it was just a nice, interesting 30-year cycle, and maybe it's going to last another 30 years to be determined. But so far, it's been following a reasonably well 30-year cycle: 17, 47, 62, 91, 22. Just fun facts. I hope you find them fun. I just wanted to show you that there's always a method to the madness. And with that, thank you so much for listening. Take care, trade safe, and I'll see you all on Wednesday. Bye.